Well, good morning, everyone, and welcome to our now third live stream or Simply Tax Talks. We're excited to, again, be here to help you just understand what's going on. There's just been so much, I feel like, to put it lightly. It was a busy week, another busy week in Washington and Congress. And so we're going to be breaking that down today. But of course, one of the benefits of live stream is the fact that we get to interact with you. We get the comments in real time, see what you're thinking, what you're liking. We like to do a few polls along the way. So we're going to kick one off here before we jump in today, just to maybe even help us guide our conversation, right? So the question that I have for you, and Yelena and Tad do as well, is what tax-related area of the Build Back Better agenda are you most concerned about or closely watching right now? Are you mostly focused on the individual side, the business side, or maybe a combination thereof? So we'll let you put some of your responses in there, and we'll check back with you on it. But in the meantime, I'd like to go ahead and invite Tad and Yelena to join on, and we'll jump into the top tax topics for this week. All right, Yelena. So I'm going to go to you on this one. We'll start with the $1.2 trillion bipartisan infrastructure package, or the, I guess it's Infrastructure Investment and Jobs Act, I guess as it's known, right? And it has about $550 billion of new spending. So, yeah, what happened with it last week? What was the headline, and how did it happen?
Well, it finally passed the House, which we've been waiting for that since August when the Senate passed the bill. So it's been a few months. If you are new around here or you can't keep track of which bill we're talking about, this is the bill that it's mainly infrastructure funding, but the provisions that we've been talking about from the tax side include cryptocurrency information reporting requirements, which was a big one, the renewal of the Superfund excise tax for 42 chemicals, and an early into the employee retention credit. Those are the tax provisions that we've been kind of watching. But this bill originally passed the Senate back in August and went to the House for a vote. That was the last step before it goes to Biden for signing. And the House was holding it, the phrase is holding it hostage, basically, because they were saying, hey, we're not going to vote on this. There was a group of progressive Democrats who were saying, we're not going to vote on this bill until we finalize the reconciliation bill. And so they wanted those two going through Congress side by side. And so as we've been talking the last few weeks through the negotiations for the reconciliation bill, the infrastructure bill's kind of been sitting on the back burner waiting for the other bill to get done. And so in an interesting turn of events, this bill has tried to go up for a vote twice, but because the Democrats couldn't get the votes lined up, it kept getting postponed. So it was postponed to last week, and the moderates and the Democrats, the moderate Democrats and the progressive Democrats negotiated late into the night before it went up for a vote. And in the end, probably because of the elections that happened last week where the Democrats lost a lot of seats that they thought they were going to win, because of that, I think that probably spurred them to, we actually need to get something out there and get it out there soon. And so they came to an unspoken agreement between the moderates and the progressives, Democrats, to pass the infrastructure bill and get it to Biden to sign and pass into law while they finalize the last pieces of the reconciliation bill. So it was kind of a slow going, and then it just went and passed the House. So that was a big win for the White House and the Democrats. And so you probably hear a lot of talking points from Democrats right about now about that.
Yeah, and I got to say, I mean, you mentioned to it, right? It was sort of being held up for it. And I mean, we still didn't obviously see the budget reconciliation piece done. So yeah, what was the agreement they had, and how were they able to get there, considering it didn't actually, the reconciliation piece, at least the Build Back Better piece, hasn't happened yet, hasn't been finalized yet?
Well, it's a lot of, I think, unspoken promises. There was talk about a procedural vote to kind of agree to, like a preliminary, like I will vote yes eventually. But the last we've heard, it's more of a understanding that that was reached between the White House and the Democrats in the House specifically. So they're kind of taking it one step at a time, trying to get it passed through the House, and then the Senate will be its own beast. But to get it through the House, we're hearing there's, I believe, 6 Democrats who are saying they won't vote on the legislative text for the reconciliation bill until they see a CBO scoring, which is basically a report that comes out and says this is how much this bill is going to cost. And they're worried that the revenue raisers in the bill aren't enough to cover the spending. And so they're saying, you know what, we want to wait for this report to come out. We want to see the numbers before we vote on this bill. And so progressive Democrats originally pushed back. They're like, no, you need to vote. You need to vote. You know, we've seen the JCT estimates. Everything's paid for. We need to vote on this reconciliation bill. But because the Democrats have a 3-seat delta in the House, 6 votes actually makes a big difference. And so they compromised and said, you know what, we'll give you some time. We'll wait till the CBO scores come out. You can look at them. And then as long as you promise to vote yes, once you see that report, we'll let the infrastructure bill pass, and then we'll vote on the reconciliation bill probably the week of November 15th. That's the estimate as of now. So,
Okay.
yeah.
Yeah. So, all right, now, Ted, I'm going to ask you this, or I'm going to go to you on this one, because, you
Okay.
you had predicted that it would ultimately pass the infrastructure piece. So going back to that, right? What we saw happen late on Friday night there, and there wasn't amended. The Senate version wasn't amended. So that, I guess, let's talk about what it means for the employee retention credit. Obviously, we've talked some about it already, but now it looks like it's headed to the president's desk and he's expected to sign it. So now what?
Yeah, and again, not really wholly unexpected at all. Just simply because of the politics involved, it was pretty certain that they weren't going to change it because they would have to go back to the Senate to have another vote there. And as we can tell, trying to get a vote out of either one of these, delegations or these groups is very difficult. So pretty much expected, although I think there were some folks, holding out hope. So as far as the retention credit goes, obviously it's, now been, or will be, as of next week, be terminated as of September 30th. And I know there are still some people out there that probably were reducing their payroll tax deposits in the fourth quarter in anticipation that, somehow there'd be a Hail Mary here and the retention credit would survive. But, so now we're at the point where I think we're going to have to be getting some guidance from Treasury, from the IRS, about how to make up for those deposits. And again, making up the deposits is one thing, but we just want to make sure that there are no penalties, on any of these payments that are coming in late, because, people really were, going by what the law was at the time. So there shouldn't be any penalties on these things. But I think we mentioned last week that the ICPA has sent a letter to Treasury, and the folks in Congress, regarding, getting waivers out there right now. I don't know if they're going to be able to waive any interest on it. Interest will be probably relatively inconsequential, if it's out there, but I would be a little suspect if they can waive the interest. But right now, what we're going to be looking for is any kind of guidance from the IRS. And again, it won't be coming till after the bill is signed, but we should be hearing some kind of leaks coming out, but not unanticipated. Hopefully, on our first program that we did was prior to the due date of the third quarter 941. So one of the things we suggested people do there, if they hadn't filed the 941s and you had credits in the third quarter, is to not refund them and to apply them to your fourth quarter. So hopefully a lot of people took advantage of that and won't have to dig into their pocket here to come up with these amounts they hadn't paid for the fourth quarter.
Absolutely. Yeah, because that's not an unwelcome surprise. I guess they don't usually, I always say they don't mess around with that when it comes to payroll tax deposits.
Yeah, that's one thing that I found is that, you don't mess around with that stuff. So.
Yeah, absolutely. So, well, I guess, Elena, maybe back to you on, there's been a few things that have happened, obviously, on the Buildback Better side. So kind of, now the first track sounds like it's on track. Expected to get signed. Of course, it's never over until it's over and done, but right? And that's supposed to maybe happen next week. I think you're thinking, Elena, or that's what you're hearing, right?
Yeah. So part of Congress, I think the House is out on recess this week, and Biden has said that because this bill was bipartisan, he wants Democrat and Republican lawmakers who helped negotiate the deal be at the signing. And so since they're out on recess visiting their states, once they come back next week, they'll schedule a signing ceremony and make it all official for Biden to sign it next week.
Gotcha. Yeah, because it certainly is something that they'll want to take a little bit of a victory lap on, I'm sure, in terms of getting this accomplished. But so that tees up the second track, which obviously is linked here because we've had some promises made that there would be a vote on the Build Back Better piece. As that was being discussed last week, obviously the previous week we saw a lot of changes to the framework based off of some of the concerns about tax rate increases and so forth. What happened last week as we were trying to get that to the finish line as well?
Yeah, so last week we got an updated framework and an updated legislative text released to the public, which looked very different from what we saw from the original House and Ways and Means proposal. But the big thing that everyone was, I guess, relieved, maybe surprised to finally see is salt cap relief. That's something that's been said is under negotiation. It's something that a lot of Democrats said they won't vote for the bill unless some kind of salt cap relief is in there. And we finally saw a version of a proposal that made it into the legislative text, which is the first time we've seen that during these negotiations. The latest legislative text increases the salt cap to 72,500 through 2031, and it would be effective for taxable years beginning after 2020. So that's what's in the latest bill. However, there was the House Budget Committee chair, one of the Democrats, released an amendment to further modify that, and he wants to increase it to 80,000 for 2022 through 2030, and then drop it back to $10,000 in 2031. So it's a little bit higher cap, but a year earlier ending date than what's in the legislative text. But that's just an amendment, and some news articles and speculation is that that's the agreement that Democrats actually negotiated, but it just hasn't made it into the legislative text. So we'll see if that updated salt cap actually makes it into the legislative text, or if what's currently in there, which is 72,500 through 2031, if that's what makes it for the House vote. So that's kind of up in the air, but it's not that big of a difference, I think, at the end of the day. But that's kind of where we're looking at for the salt cap relief. And then, of course, we have to note that just because that's what's in the bill now, this hasn't gone to the Senate yet. And the Senate has been kind of the biggest obstacle. Some of the senators have been the biggest obstacle in all this, saying what they will and what they won't vote for. So once this gets to the Senate, it's fair game for anything. And so they will probably make further changes to the salt cap relief negotiations as well. For example, Senator Bernie Sanders says he wants to do an income threshold. So those making over 400,000 and under 400,000 have different rules. But again, we don't have a proposal for that. We just have what the House has now. And that's subject to change both before it goes up for a floor vote in the House and in the Senate. Another new thing that we saw last week is some IRA provisions are back in, which they were taken out in the end of October version. I think it's the October 28th version took it out, and then the November 3rd version put them back in. So it's kind of some flip-flopping going over there. And again, we don't know if they'll stay in or go back out with the next version. As of now, the latest version has these provisions back in. So those provisions, as a reminder, are the contribution limits. So setting limits for 10 million for traditional retirement accounts and Roth accounts. And then that would also trigger mandatory distributions once an account reaches $10 million and exceeds that limit. There's also a requirement for retirement accounts with at least 2.5 million to report their balances annually to the IRS. And both of those provisions would be effective for tax years beginning after December 31st, 2028. So it's kind of out in the future, but something to keep in mind as coming up. Then another big one is the bill again tries to close the backdoor Roth IRA strategy that we call, which prohibits all employee after-tax contributions in qualified plans and after-tax IRA contributions from being converted to Roth, regardless of income level, effective for distributions, transfers, and contributions made after December 31st, 2021. So that one would take effect pretty much immediately. And that's something that I know, Damien, you've been keeping an eye on since that's a big consideration or a big policy that we've been eyeing this entire time for our wealth planning and estate planning clients. So those are kind of the big ones that reemerged last week that we were kind of maybe surprised to see or weren't expecting to see the way they ended up.
Absolutely. Yeah. I guess on two fronts. I'll start with the IRA side of things, just kind of share my 2 cents. I mean, definitely the requirement to take out distributions is one that's really, caught a lot of eyes. And I think it's also been a bit confusing, right? Because it was out and then it was in and then it was out and it's in. So we're, trying to track where things going. And I think, Lena, you made a great, point there earlier, kind of a soundbite I'll make of, it's not over till it's over. It's going to go over to the Senate and it may change again. And And so you just really have to make sure you're watching, the article you're reading. When was it dated? What's the latest? Because the conversation is just sort of this bouncing ball you have to really watch. But I guess with the current version and it kind of coming back in, these requirements to take these distributions for the traditional and the Roth accounts once you get over the 10 million, I think it's a good thing too that it's maybe out a bit of ways. So if that goes through, I'd say from a planning perspective, that's something that you really want to start to look at if that's something that's going to impact you or someone maybe there are some things you can do to try to manage, income tax bracket management on the individual side is always something that's really important. And if you have some time, you can work with the timing of the distributions. Maybe you can manage your brackets a little bit better, particularly if there's going to be some surcharges and things like that kick in over certain thresholds. So it's definitely something to keep an eye on. And then maybe back on the SALT cap, obviously that's been a big deal for many that we work with. We work with a lot of closely held business owners, and the tax that's being paid really on the income from the partnership and the S corporation that's flowing down through to the individual. That all kind of gets hung up at the individual level, since with the TCJA that we had in 2017, that there's that $10,000 SALT cap that we keep talking about. That's all of your state and local taxes kind of put together. Can't go over that amount. So it would be probably beneficial for some, I think, to get that higher limit. And actually, what's interesting is maybe where we started the conversation is everyone thought that this would maybe not be a good thing for them. With the SALT cap, it actually might mean that, overall these changes could be beneficial for you. And again, it depends on your facts and circumstances in the tax year. But yeah, maybe we'll do a little, we're doing a little polling question here on, whether or not a temporary increase would be beneficial to you. Majority are saying no. Maybe it's almost evenly split between no and yes and not sure, because it is definitely tricky. And there's also some state, there were some SALT cap workarounds that many of the states, including Illinois, which I'm sitting in currently, has put in place. So it'll be very interesting to see how that works out and maps out too. So
David, a couple of things on that, on the SALT thing. Two observations. One is, I don't think, again, this is just my opinion on this, but I don't think there's any question there will be a SALT cap extension in the final bill one way or another. And the reason that is not so much from, giving a benefit to, to certain people or certain groups or lower income, higher income, whatever. I think honestly, it has to do with the revenue that actually raises the way. And it kind of goes to the, some of the funny math that they use to determine how revenue is raised, to determine whether this is revenue neutral or not. If you recall that the current $10,000 SALT cap was scheduled to go away, I believe in 26, it would go away. Mm-hmm. So the way they score this is say, well, look, with no cap, everybody can deduct 100% of their state and local income taxes beginning in 26. Well, if we put this 82 or 72.5 cap on there, we actually raise money, because now we're capping it at 72.5 until 2030 or 2031, instead of actually cap or having no cap. So we actually make money on this thing. So that I just think, and plus politically, it reads well for them if they can get that cap back in and gets the bill actually probably moving forward, because of that group of senators and representatives who are drawing the line in the sand that say, hey, look, we have to have some relief on this. So. And that's one thing. But you brought up another good point, is many states are doing these SALT workarounds, and there is some question out there about if you put this, extended cap to 72.5 or 80,000, will that put in jeopardy some of these state tax workarounds for having the partnership or the S corps actually pay the state income tax? Because some of those laws are written as such that they refer back to a $10,000 cap, as opposed to an $80,000 cap, and maybe it doesn't come into play if you have a higher cap on there. So there's a lot of questions out there, but I think overall that you will see an extension or an increase in that cap to at least 80,000, not because it's they're trying to, well, outwardly they're saying they're trying to give a benefit to the people, but it's because of the revenue that it actually raises.
Yeah, I thought that was interesting how they drew that up, right? Because we've heard a lot of the talk about how that's going to be something that needs to be in there to be able to move forward. But then how are you going to fit it in because of the cost? So it's sort of an interesting way that, like you said, it actually kind of flips the script a little bit and actually raises revenue.
Yeah.
So I guess now I'll get each of your takes on this. Now we kind of know where we are, the triple B, where we're standing on things. what's next? Maybe Tad, what headwinds do we have? Do you think we're going to see it move along next week? And then kind of where do we go from there? What happens from there, right?
Yeah, I think, the biggest headwind, and Yelena, talked about it earlier, is that CBO scoring, the Congressional Budget Office, scoring on here. I think that's going to be the deal. I know Speaker Pelosi had talked about a vote on this thing on Monday, the 15th, which is the first day they're back from recess. I don't know that those scores are going to be released at that point. I've seen estimates anywhere from next week to the week of Thanksgiving. Is when those would be released. So, and then the real question is, be careful what you ask for. What happens if that scoring comes back? It's like, oh my God, this thing doesn't come close to, to paying for itself. So now you're back into, for the House, I don't know, are they back to square one? Which, again, I kind of have this overriding belief here that the House is going through all these machinations for no reason. The Senate's going to be the one who is going to, I think, end up controlling this thing with what they're going to put out. Yes, there's some people that are concerned about the CBO scores there, but I'm more focused on what what we hear out of the Senate here the next week or 10 days about what their proposal may be, as opposed to so much what's going to come out of the House.
Yeah, no, I agree with you entirely. Yelena, I don't know, what would you add to that? Do you agree? Anything you're kind of watching differently?
I think it's just a waiting game at this point. I mean, once we see the scores, again, like Tad said, that could make everyone go back to the drawing board, or it could be a really swift passage in the House and it goes to the Senate. We kind of start this whole negotiation game from scratch, just because, for example, Senator Wyden has been very outspoken about what he wants to see in there, including his billionaires tax. He called the IRA provisions in the House bill interesting, which, I don't know if that's a bad thing or a good thing, if it's going to be changed or not. And then, you have Senator Bernie Sanders, who has his opinions and preferences and what he wants in there. And so, that's not even, again, bringing in Manchin and Sinema, who have been the ones who holding up so much of this or changing so much of this. So it'll be interesting to see, once it passes the House, we're kind of probably going to go into a whole new debate once it reaches the Senate. So it might be a few weeks before we actually see any final legislative text.
Yeah, no, we said it before. It's going to be a kind of a mad dash into the year, and it certainly looks like we're setting up for that. So I guess with that, as I always like to do, I like to get Tad's takes on things. So let's get Tad's take. All right, Tad. So here's the situation that I'm seeing pretty frequently here, and I'm sure you are as well, is, and many of our that are watching here, I'm sure saying, we're heading into those last 2 months of the year. It means it's everybody's favorite time of the year, not just the holidays, but also year-end tax planning season. I know it's obviously I'm a little biased in saying it's a favorite time of the year, but what do people do? We're still in this uncertainty. We don't even know where things are going to land, what the rules might be next year. How are you answering that question with those that you're talking with?
Yeah, it's a pretty timely question. I'm, spending, the next 3 days out here in Southwest Kansas with a, group of clients out here that we do year-end planning with. And we kind of, the approach we're taking is, look, we got to deal with what we have in front of us, right now. So, I mean, you can't be paralyzed about, well, geez, I can't do anything because I don't know what's going to happen. You deal with what you deal with. Okay. And you got some flexibility built in. I think by the time we get closer to year end, we'll be able to know a little bit better about what next year may look. Nothing's really going to affect the current year, that's happening. But again, planning is not a 1 year process. It's a 2-3 multi-year process. So, but hopefully by later in this year, we'll have a lot better feel for what next year may bring. And again, just build some flexibility into what we're doing now, and that's kind of what I'll be doing out here for the next 3 days. Is kind of get a preliminary plan, but you can pivot if something does change. Got a pretty good idea out there what may or may not change, but we just have some flexibility, but just don't be paralyzed. And again, the biggest thing is don't wait. Don't wait for something to be finalized, because like I said, I mean, it'd be one thing if we had, the original Ways and Means Committee report out there as what we were dealing with. It had just, a tremendous amount of tax provisions in it. But here right now, even in the House bill as it came out, the tax provisions are not that extensive, that are in there. So yeah, they're meaningful, to a number of people, but just some flexibility and just kind of, go on with how you normally do your planning.
Well, there you have it. I agree completely. I feel like flexibility and modeling have been the words I've been using frequently here. And that's about all you can do right now. And multi-year approach, right? I mean, absolutely. That's the name of the game. So, all right, well, let's get our top takeaways for this week. And we'll start with, while we're doing this, we were running a little poll here on our frequently asked top question as to whether or not we'll see significant change enacted for the end of the year. And so always like to kind of track the results here. So make sure you get your answers in as you're watching there. Get your questions in as well if you have them. We love answering questions. So, all right, Yelena, let's go with you. What are you watching for this week? And again, maybe keeping in mind that obviously, like you said, you get a little bit of a recess in terms of maybe what's going on in Washington.
Yeah, so it's kind of a slow week. So I don't know that there's much to watch. I mean, I'm sure there'll be various leaks of negotiations ongoing because, again, this isn't a done deal. And just because they're on recess doesn't mean the work stops. So there might be a little bit here and there. But I think overall, it's just making sure that we're catching up on the latest legislative text, making sure we're understanding what's in there. And I know a lot of people get confused, about what exactly is in this bill. We've seen so many different versions and all the negotiations, they change from day to day, which can be overwhelming. And so we're always here as a resource for our clients. If they do have questions, just reach out. We're happy to walk you through it and tell you, this is what's the latest news. This is what, we're considering, what we're watching. We're happy to be that resource for you because it is a lot to muddle through and a lot to keep track of. And it's, again, changing daily. So I think mostly just being a resource for our clients and our firm, making sure that we're staying on top of things and just walking through it day by day.
Absolutely. Well, I will say you do an impressive job of it. Tad, you do as well. So what are you going to be watching this week, Tad?
Mainly going to focus on anything you hear out of any individual senators. Yelena made a good observation early on, and I think one of the wild cards out here is not so much Manchin and Sinema, is who else. I mean, you take a look at it. I mean, any one of the senators could turn into a Manchin or Sinema. Right now, I think my biggest wild card out there is Wyden. Yelena mentioned that earlier about, he's been pounding the table, on the rate increases, the billionaire tax, which, isn't, probably all that big a deal, but, for our client base. But, if he starts talking about, rate increases again, then we're talking about a whole different deal. And I think that's going to open it up. But that's kind of what I'm looking for, along with just to see if the IRS is going to try to get out in front of this retention credit thing. I doubt we'll see anything until, Biden signs a bill, but we'll be keeping an eye on that. And as soon as we do hear something, we'll let folks know.
Yeah, no, again, you're doing a great job with that. And it is so hard to keep track of the moving ball here and what happens. But I think you're right that, I mean, this environment, it's any one senator, right, can definitely change the direction of things as we get over to the Senate. So, I think, Yelena, you were kind of alluding to this. I think we're going to have probably a busy end of November and definitely a busy December. And who knows, Tad, to your point, maybe the direction changes yet again. So maybe back to that flexibility. Maybe don't pull the trigger yet, but get ready for it and kind of know what you're playing with and what you're working with.
Right.
Absolutely. All right. Well, I think that kind of does it for our session here today. We'll be back again next week, 10 a.m. Central, to talk through these things. And again, Yelena and Tad, thank you. I know we, the three of us, were actually all able to get together last week at our firm leadership conference that we do, and we were just chatting through a number of things. And I just, again, hear great things about what you do, and I want to thank you again for all of the time and what you do to help us all keep track of everything, even in the midst of a conference last week, while watching everything that was developing. So again, thank you both. And thank you for watching. And again, don't be shy. Let Yelena, Ted, I know how we can help with questions. Have a great day, and we'll talk to you soon.